Nobody likes paying taxes. More importantly, nobody likes the admin of paying their taxes. Let's face it, for a lot of us, paying taxes is an admin burden where you have to go through countless forms, keep track of expenses, create reports, and make sure that everything is up to date and then pay your taxes. There's a tax secret in South Africa that nobody talks about that can help small businesses reduce their taxes and reduce their tax admin burden so they can pay their taxes easily and efficiently. This is what we're going to be talking about in this video: turnover tax. Let's get started. So, what is turnover tax? Turnover tax is a simplified, optional tax system that SARS offers to micro businesses. Its entire purpose is to simplify tax compliance and make it easier for micro businesses to submit their taxes. So how is it simple? Compared to the other taxes that are calculated on your profits, turnover tax is calculated on your turnover or your sales. So you have no need to do the calculation for your profits to wade through the allowable expenses that SARS will allow you to deduct from your revenue to calculate profit. All you need to do to submit this tax is to know your turnover or your revenue or your sales, and you'll then be able to submit tax on that. But it does not mean that your taxes will be higher. Let's talk about the tax rates that are offered under turnover tax. So we're going to look at the turnover tax rates and see how much you actually pay based on your revenue or your turnover. So when I say turnover, I'm speaking about the sales that you make, not the profits that your business makes. So for the tax years that end between 1 March 2024 and 28 February 2025, these are going to be the turnover tax brackets. So it's on a graduated scale or a progressive scale, where if your turnover or your sales are 335,000 or below, you do not pay any tax. You only start paying tax from when you cross 335,000. So the next portion of your sales will be taxed at 1%. So if you're making 500,000 in sales, you only pay 1% of the amount above 335,000. So if 500,000 is your sales, your tax will be 1,650. If you then make above 500,000 but below 750,000, that portion of your sales will be taxed at 2%, meaning you would only pay 2% on the amount above 500,000 up until 750,000, and you pay 1% on the amount below 500,000 but above 335,000. So if you make 750,000 Rand in sales, your taxes would be 6,650 Rand. The amount that you make in sales above 750,000 will be taxed at 3%. So as you can see, these are very, very low rates, and they're calculated on your turnover and not on your profits. If you are a micro business that makes up to 1 million Rand. Remember, the difference between turnover tax and small business corporation is that small business corporation is calculated on your profit. Your turnover could be up to 20 million. So if your business has low margins, where let's say you make the full 20 million and your profit is 1 million Rand or less, you would not qualify for turnover tax, but you could qualify for SBC and pay lower tax rates. If you don't qualify for SBC, then you're just paying 27% on your profits. If you don't qualify for turnover tax, you would then be paying 27% on profit. So you would now have to go through submitting your income tax return and calculating your profits based on the allowable expenses that you can deduct in your business. Awesome. So we're paying 3% at most in our taxes, and we're only submitting our turnover. We're not going through a bunch of documents and forms to fill out and submit our taxes. So turnover tax gets even better. It gets better because it replaces the other taxes. It replaces income tax, both for you as a person, if you're trading as a sole trader, or for a business if you're running your business through a registered company. In that case, you don't have to go through the normal steps of calculating your corporate income tax, submitting all the documents, and submitting your ITR 14, and then also paying in your personal capacity. It also replaces capital gains tax. It replaces dividend tax when you pay yourself out of your business. So it's a great option for you if you do qualify. The VAT question is optional. So you can stay VAT registered if your business needs to be a VAT vendor, but you don't have to be VAT registered as well. So it can replace your VAT as well. So it's going to be very important for you to make sure that your business does qualify and look at the specific circumstances of your business. What do you plan for the future? How is that going to impact your taxes? And how is that going to impact your business? I'll be happy to do a free consultation with you to go through your business, your numbers, and walk you through the entire process to see if it's something that you could potentially take advantage of. You can find the link in the description for you to book a free consultation and for us to discuss your taxes and your business. But if you enjoyed this video and you found some value in it, please like the video and subscribe to the channel so other entrepreneurs and business owners just like you can find this content. I'll see you guys in the next one.